All right, everyone. Welcome to week 3. Today's agenda is the following. I'll go over the quiz that you took last week. So a little bit about the quiz. I think some of you maybe have turned the quiz or answered the questions a bit too early before getting to the end of the lecture. So I think only less than half of you got full score, while the rest of you probably got 1 out of 2. No, I don't think anybody got 0. So I will go over the solutions very slowly, just to make sure you know how to answer these kind of questions, because this is what you should expect to see on your CFA exam if you do intend to take it or something like that. Okay, then I'll go over some Q&A questions that some students had last week, as well as go over the triangular arbitrage exercise that I went over last week too. So I'm afraid that maybe some of you don't know how to approach it, so I'm just going to walk you through it again and hopefully give you a little bit more intuition on why the triangular arbitrage works and what exactly is the triangular arbitrage trying to accomplish. So that's probably what I hope to share with you during that discussion. And then finally, before going on to today's lecture, I will go over the ungraded problem set number 2, the solutions. Yeah. All right. So let's go over the quiz, right? All right, so the quiz question number 1, I think almost basically everyone got this question. It's just testing your knowledge if you understand the jargon, the nomenclature of currency, foreign exchange language. Yeah. So if the exchange rate value of Canadian dollars, that's what CAD stands for, goes from US dollar of 60 cents to 80 cents US dollars, then the Canadian dollar, A, appreciated and Canadians will find US goods cheaper, B, depreciated and Canadians will find US goods more expensive, or C, depreciated and Canadians will find US goods cheaper. So this is just a test of whether you understand what this term basically means. So I tell someone yesterday, you should just think of currencies just like any other financial asset that you looked at in your other classes, whether it's oranges, coffees, or whatever. Just think of Canadian dollars just another one of these assets, and therefore 0.6 cents and 0.8 cents is just the price, right? We're just observing price changes. And so when the price of Canadian dollars goes from 60 cents to 80 cents, what we're really just saying is Canadian dollars are just more expensive now, right? Some asset now has a positive return and it costs more to buy it using US dollars. So there's 2 different ways to see it, right? One from the perspective of the holder of the foreign asset, the Canadian dollars, and then the other is from the perspective of the US dollar holder. So if we just take it from the perspective of the Canadian dollar holder, right? That's what it's asking. Then it appears that the Canadian dollar is getting stronger, right? Because it costs more dollars to buy the same unit of Canadian currency, and therefore the appropriate description of what happened is appreciation, right? Appreciation of the Canadian dollars. So just based on that understanding, that increases in prices of the underlying asset that we're talking about, which is Canadian dollars, there is only one solution, right? A and B and C are both wrong, right? Because we're not describing depreciation of the Canadian dollars, right? If you want to see depreciation, you would see that the dollar getting stronger, which is not. Yeah. All right. So the last part, find US goods getting cheaper. Yes, if goods and services that's denominated in US dollars stay the same, given this exchange rate change, then of course you can buy more with the same amount of Canadian dollars than before, right? It's as if your currency became stronger. I mean, in real terms. Yes. All right. So that's summarized with these 2 points. The price of Canadian dollars in terms of US dollar has increased, right? Because 1 Canadian dollar now costs 80 cents as opposed to 60 cents, and therefore Canadian dollars are stronger, right? The opposite interpretation is from the perspective of US dollar holder, right? Now, if I want to buy Canadian dollars, it costs more. So US dollars therefore are depreciated. That's the new terminology that was introduced to you last week. All right, comments, questions on just FX terminology. So just get used to it. When we talk about positive returns on foreign currencies, we're talking about appreciation of the currency, right? Because it's priced in terms of local currency, and if its price increases, that means it costs more and therefore has positive returns. Depreciation is the other, is negative returns, right? If the price of the asset goes down, that means that it costs less to buy it, right? And therefore your local currency is stronger, right? Relatively speaking. Okay, so that's question one. Okay, question two. This is where the confusion most of you got. So I think, again, a little bit less than half of you chose A, which is the correct answer, and I'll show you why it's A. And I think the majority of you chose C. And I believe the reason why you chose C is because you got the foreign interest rate and the domestic interest rate flipped, okay? So how do you approach this question? So let me read the question. Suppose the 1 year nominal interest rate for the US and the EU are 10% and 9% respectively. So that sentence means that the US deposit rate is 10% and the EU deposit rate is 9%. If the spot exchange rate of euros per dollar is 0.8, so that means that it costs 0.8 euros to buy $1 US. The no arbitrage 1 year forward rate of euros per dollar rate is closest to which of the following? All right, so basically, if you read that sentence, you should be thinking, all right, I know this formula that I picked out from last week. All I have to do is apply this covered interest rate parity, plug the numbers in, and then I can solve for F, right? That's basically what should be going through your thought process. All right, so but before you do that, before you pick up that equation, what you should do is first identify which country is the domestic country and which country is the foreign country. Okay. Once you establish that, then you know exactly where the numbers go. So how do you do that? Well, first you just look at the exchange rate that's given to you, right? If you look at that equation, I mean that pair of currency code you learned from last week, I always write the foreign currency in first. Okay, right? So USD is therefore the foreign currency here. So that means that R star refers to US dollars. Yes? And the numerator, or the currency that follows USD, is the domestic currency, right? The euro. So that's going to refer to R, right? So R star refers to 10%, and R therefore refers to 9%. Yes? So if so that's what I wrote here. R star is 10%, R is 9%, and now we have E, which is, again, euros per dollar is 0.8. Yeah? So we know R star, we know R, we know E, right? Based on what's given to you, right? This currency pair, the way it's written. I even explained to you that it's euros per dollar in the quiz. Then you know how to assign the variables, R star, R, and E. Plug those variables into the CIP equation, which is the following, right? And you should just solve for F. Yeah? So the answer should be 0.79, which should be A. So just to recap, if you see this question in this class or standardized exams that has multiple choice, the first thing is to look at the exchange rate that they give you and determine which country is the foreign country, which currency is the foreign currency, which currency is the domestic currency. Once you figure that out, then you know which one is R star, which deposit rate is R star, and which deposit rate is R. And then you plug R and R star into the equation with the appropriate E and solve for F. Done. Okay. So your question may be, well, what if I inverted E, 1 over E? Fine, you can do that, but just make sure you get it pairs correctly with the R and R star. Yeah. So if you want to assign USD to R and R star to EU, the euro, fine, but you have to take 1 over E for the converted exchange rate, right? You have to reverse it. All right. Questions, comments on this kind of setup? So if you ever see it again, I shouldn't see anybody making a mistake like this. All right. If no questions, so let's move on to the Q&As. So the first Q&A, somebody asked me, how do you interpret the forward premium and CIP? So if you recall from the CIP, right, maybe I'll write out its raw form here. F minus E over E over E, right? It looks like this, and the forward premium is referring to just this term here, and which looks like every term, but it is not, okay? But it's supposed to characterize specifically beliefs, okay? Traders' beliefs or everybody's, the whole economy's belief of what future E should look like, right? That's what F minus E over E should represent. If you believe you know what future E is going to look like, you may want to speculate in the futures or forwards market. So F is supposed to represent the entire economy's beliefs of what future E should look like. That's how you should think of it. And there is a term that characterizes that interpretation of the forward premium, and it's called the unbiasedness hypothesis, which I didn't put in the slides because you'll never see it again anywhere else, okay? But the idea here is that we can swap F out for average beliefs about what future E should be if we impose some assumptions, which we will do today, okay? All right. So what does it mean in the context of CIP? It's supposed to mean basically that it's the return expected return you get on holding on to foreign currency that wipes out any sort of interest rate differential that you may profit off between two bank deposits. That's basically what CIP means. If it's not large enough, then there's going to be arbitrage profits. So just simply from an arbitrage argument, the forward premium is just the return that you need to eliminate any sort of arbitrage possibility from exploiting interest rate differentials between countries. That's it. That's strictly speaking what that represents. We can get to this interpretation once we impose some assumptions, which allows us to swap out average E, future E with F, okay? So I hope this notation is not too foreign to you. So this E function is supposed to represent expected value or averages. So maybe, I don't know if anybody I hope everybody has some exposure to statistics. But if not, I'm gonna try to refresh your memory. But that's kind of what the E function represents. It's supposed to mean I'm taking the average of all possible beliefs about what future E is going to be. And I'm saying here, the unbiasedness hypothesis is saying here is that the future price should represent or somehow capture those beliefs, those average beliefs. All right, so that's just intuition, but I'll get to the economic assumptions necessary to get that to be true. Okay. All right. Question 2, is the forward premium the return I can get from entering the forward contract? All right, so this is a very, very subtle question that I often get from students who have no background in derivatives. But given that most of you have background in derivatives, I'm not too worried. So what I just described to you in the beginning here, right? This term here, F minus E over E. Again, this is a expected belief about the returns of what E would be in the future. Okay, so imagine E is E plus 1. So ET plus 1 minus E divided by E is just a return, right? The actual return of what E would be in the future. That is not the return on a forward contract. The return on the forward contract is whether or not you can sell or buy back cheaper with the realized value of E in the future. So let me give you an example, okay? Suppose you are engaged in a long forward, which means you're going to get delivery. You're going to get delivery of the foreign assets in the future, and you're going to pay out a fixed price F, right? So your payoff actually looks like the following. you're going to get minus F, right? You're going to be paying out something, but then you're going to potentially sell this underlying asset on the market, right? So let's just say E prime is the realized value of the underlying asset in the future. So you don't know what E prime is going to be today, but you're gambling, right? So this is actually your return, right? This is your return on the forward contract. It's whether or not you are correct or you benefited from your speculation. So you're kind of speculating that if I pay a fixed F today, the underlying asset may grow up to a value that exceeds the F that I can sell for in the future, right? So future E minus the price I pay for the underlying asset is actually your return on your futures contract. Okay. If this is confusing to you, you can wait until the last third of this class. I can explain in more detail, but that's the idea. So to answer the student's question, the return of a forward contract is actually future E minus F. And if you want to scale by F, you can, okay? It's fine, right? That's the price paid. Whereas the forward premium, to remind you, it's F minus E over E, right? It's not the same, right? It's not a return on the futures or forwards contract. It's your belief or the market's belief of what future E is going to return to you, right? If you hold it on today and decide to sell it in the future, right? So in other words, here we're assuming you're holding onto the currency and expecting it to go increase in value. Here is you're speculating about future F. I mean, speculating about future E, and you're paying F in the future, and then selling the underlying asset for some unknown price, right? That's what it is. All right, so the example I just elaborated, right? Suppose you are long forward, you promise to pay F for some unit of currency in 1 year. If the price of the foreign currency is ET plus 1, whatever it is, I don't know, then my payoff is the following, right? ET plus 1 minus F. Assuming I liquidate the underlying asset that's delivered to me, right, that I paid F for. That's my return on the contract. This is the return on holding onto the underlying currency. Expected return holding onto the underlying currency. All right, so make that distinction, all right? So to summarize, the forward premium is not the same as the return on the forward contract. And if you want explicit equations, the equation is this one. Okay, this is the return on the forward contract. It's the return you get from speculating on F. Okay, you're betting basically that the future value of E will exceed F, right? That's what your bet is. Whereas this one, if you interpret F as future beliefs of what underlying E is going to be, then it's just the return you get on holding onto that currency. That's why it's F minus E divided by E. All right, so that's the summary. If you still don't get it, that's fine. Once we get to a in-depth discussion on currency futures and forwards, then we will revisit this again. There's a specific term for what I just described here, but I'm not going to say it here right now. Okay, comments, questions on the forward premium, what it represents, and what it means in the context of CIP. So again, the context of CIP is the necessary expected return, your beliefs about the currency, the domestic currency depreciation that's necessary to wipe out interest rate differentials between two countries after currency conversion, right? That's the idea. If it doesn't, if F minus E over E is not big enough or negative enough, then you can get arbitrage profits, right? The whole point of CIP is that there shouldn't be any free money available, right? And if there is, then somebody can come in and just do it indefinitely, it doesn't make any sense. All right. If no other questions, let's move on to solving my way of solving triangular arbitrage, and hopefully, again, provide a little bit more intuition on what exactly is being done in this exercise. So I brought up last week's slide here. So this is the same slide as you saw last week. And I'm just gonna walk you through my way of doing it first, and then I'll go through again the solutions, and then I'll give you some intuition. All right, so how do I do it? Well, first I identify the base currencies. So the base currency is the currency, the 3-letter code that's quoted first. So if I look at this table, I see there's 2 currencies, right? There's US dollars and there's pound sterling. So the point I'm looking at the base currency is because I want to know the currency that I can buy and sell it at, because that's exactly what the bid and ask refers to, right? It's what I can buy and what I can sell, right? And then this is the price. So that's the most intuitive way for me to approach it. So first, identify the 2 base currencies, USD, pound sterling. Next, pick a base currency and construct a chain of conversion that loops back to the base currency. So in other words, construct a path, a triangular path, right? So from A to B to C back to A is, it's a triangle. In this case, right, the first way to do it is from USD to Euro to British pounds back to USD, right? And then, as I told you last week, once you've established this path, ABCA, if you check that this is profitable or unprofitable, then starting from any other letter and following the same circular path will lead you to the same conclusion, that it's either not profitable or profitable. So just testing one route is good enough. You don't have to check B to C to A to B. You don't have to do it if you check this already. You don't have to check C to A to B back to C. You do not have to check these. They will lead you to the same conclusions, and you can prove it to yourself if you want to, okay? So you only have to check one route, right? You only have to check, you only have to check one starting point, right? It doesn't matter if it's from this point. It doesn't matter if it's from this point. It doesn't matter if it's from this point. As long as you check from one starting point, you're done, okay? You either conclude that there's arbitrage or there's no arbitrage. Okay. If the currency conversions yield more than what you started with, you have identified profits. Otherwise, you don't. All right. If not, try borrowing the other base currency and construct chain conversions that is different. All right. So what that means is that in this case, I already tried US dollars. So so it worked. I can also check the other route. So instead of borrowing USD, I'm just going to go ahead and borrow British pounds. All right. But it's not going to be any of the routes that's identical to the one above, right? So here, if I checked A to B to C to A, and I start from B, I'm not going to go to C, right? Because that's covered by this example here, right? It's covered. So instead, I'm going to go from B to A to C to B. So just notice that this is not the same as this, right? It's not the same. So again, the reason why I start with the base currencies, because I can directly read the quotes. That's the whole point. I can just read the quotes. I have a starting point, right? You don't have these the base quotes. You can use the quote currency too, and I'll explain to you later how to do that. But the intuition is a little bit different. All right. The reason why I do it with the base currencies because if you will see what I'm doing when I do the conversions is as if I'm buying low and selling high, or vice versa. I'm selling at a higher price, and then I'm buying back at a lower price. That's the intuition when you do it this way. Okay, so let me say it again. The intuition here for doing it this way, when you start from the base currency, is you're going to be trying to sell the base currency at a high price, and then buying it back at a lower price, or vice versa. Buy low, sell high, or sell high, buy low, same thing. Okay. So looking in the future slides a little bit, if you do it the other way, if you borrow the quote currency, the intuition is not sell the quote high, right? It's actually using the stronger currency to buy cheap, right? To buy cheap and try to sell the cheaper base for expensive. So see, the intuition is a little bit different, right? So I'll get to that in a bit, but that's why I start with the base currency, because if you start with the base, the intuition should be clear. I'm trying to take the foreign currency and I'm trying to sell it as a high price as I can, and then buy it back cheap, or inexpensive or low price, right? A low price. Okay, so hopefully that makes sense. So here, so again, let me walk you through the steps. Step one, look at the base currencies, US dollars, British pounds. So if I start with US dollars, I'm going to identify one path, one route, okay? US dollars to euros to British pounds back to USD. So it's a loop, a triangular loop. And because I'm going to use, because I'm going to be borrowing as a starting, borrowing the base first, I'm going to try to borrow and sell it expensive, right? Sell it at a high price, right? So I go from USD to Euro. So I can sell this for this, right? I have this now. I'm going to use this to buy GP, right? And then sell this back to USD, right? All right, so that's one route. The other route, I start from the other base currency, which is British pounds. And instead of going from British pounds to USD, I'm going to go another direction, right? I'm going to go from British pounds to euros. And the reason, again, I'm starting with the base because I'm going through the same patterns here. I'm going to borrow, sell, buy, sell. It's going to be the same regardless if I borrow the base. Sell, buy, sell. So you know exactly which quote to use, right? If I'm selling, I sell at the low price. If I'm buying at the high price. Okay. So let me say that again. If you do it this way, you look at the base currencies and you borrow it. And then the first step is always sell. Then the subsequent actions are buy and sell. So sell, buy, sell. Sell, buy, sell. Okay. All right, so the intuition, as I already said, if you borrow the base, the intuition is that you're going to try to sell it high and buy low. So that's exactly what this two steps involve, okay? These two steps, you're trying to sell high, okay? And then, sorry, this step, sell high, okay? And then you're going to try to buy low, which is this step. Let me see, sorry. Yes, okay. I think it's these two groups, yes. So that's your sell high, and then you convert it back. You try to buy back low, right? Using the British pounds, or I'm saying selling British pounds, but you can say it another way. You're using British pounds to buy US dollars back, right? So buy low. Okay, so this is the sell part. This is the buyback, right? So if you combine USD, this route, USD to Euro to British pounds, you've essentially constructed an implied exchange rate, right? By doing so, by going from USD to Euros, then to British pounds, you've effectively constructed an implied exchange rate between US dollars and British pounds. And then you're trying to exploit differentials with another set of direct quotes, right? Because there is a direct quote for USD per pound, right? Here. So these two gives you an implied quote. This one gives you a direct quote. And you're seeing if there's a large enough discrepancy to make something, right? To make free money. So I emphasize again, this strategy, you are borrowing the base. And again, the intuition is you are borrowing the base so that you can sell high and buy back the currency that you borrowed at a lower price, at a low price. All right, if you don't want to do my strategy of looking at the base quotes, that's fine. You can look at the quotes, the quote currency. Sorry, the base currency, quote currency. You can look at the quote currency. So if you borrow the quote, then the intuition is different. You're trying to borrow the quote and you're trying to buy the currency that is cheap, the cheapest, okay, relatively speaking. And then you're going to try to sell that underlying currency that you bought at a higher price, okay? So here, you're borrowing the euros and we're gonna try to buy it, right? We're gonna try to buy it cheap. And then lastly going to try to sell it for expensive. Right. So again, to compare with the first strategy is to exploit the actual price of the foreign currency or the underlying currency. In this way, it's more indirect. You're borrowing the currency that is stronger, right? And seeing if you can exploit its strength using an implied quote to buy something at a more expensive price and then sell it back at a more expensive price, right? So so again, looking at the first two steps, we are basically constructing an implied Euro USD exchange rate, right? We go from Euro to British pounds to USD, and then we're comparing it to the quoted USD Euro, right? That's this one, right? We're using these two quotes to construct an implied quote, comparing it to this direct quote. And I'm hoping that there's a large enough discrepancy to make free money, right? Buy low, sell high, or in this case, buy cheap, sell expensive. All right, so we can go ahead and do it together. So let's try it this way to show you a numerical example of what's going on. So here, if we do buy low, sell high, which is my preferred way to do it, I'm going to borrow 10 million euros and I'm going to buy British pounds at this quote. So this buying expensive, right? This one is 1.155. Okay, so this is a different set of quotes. Okay, don't worry. All right, so imagine that you have a, oh sorry, this is the problem set. Okay, so if no other questions, I'm going to go ahead and go to the problem set. Sorry. So this is a different question. All right, so that's the intuition. So do you have questions on the example I went over last week? So hopefully, you have a procedure to do it now. Okay, you can just follow my steps, and you should arrive at the correct solution. But of course, you don't have to do it this way with my choosing the base currency. You can start with a quote currency. But again, the intuition is slightly different, and you just have to get used to it. Okay. All right. Let's go ahead and apply my strategy to the ungraded problem set that I'm going to go over now. All right. So let me show you what the problem set looks like. So hopefully you have had some time to look over it. It's basically testing your understanding of how to use the covered interest rate parity and the first part, triangular arbitrage. So I'll review, and very similar to the quiz that you took last week. So let's go over the first question. So the first question is a triangular arbitrage question, but there's no two sets of quotes, right? There's no bid and ask. So it's very, very easy. You just have to look at one set of quotes and identify the loop or the route. And then if that route doesn't work, try a different route, and then you should be done, right? All right, so suppose you are a trader at the foreign exchange rate desk at Goldman Sachs in London. You observe the following exchange rates, all right? You have euros per pound, euros per dollar, and USD per pound sterling. And you have these following rates. Okay, so let's try to identify a arbitrage. So I'm gonna just find the route show you the route that makes you infinite money. So I'm gonna try this one, euros to British pounds to US dollars to euro. Okay, so I'm gonna use the intuition that I presented to you just a few minutes ago. I'm gonna borrow the base and try to sell it at a higher price. Okay, so suppose I borrow 10 million euros and I'm going to use it to buy British pounds. And let's look at the exchange rate here. If I buy, it's going to be, so I'm going to borrow euros. I guess it should be this one should be buy cheap, sell expensive. Okay, so anyways, let's just do it that way. All right, so I borrow from this equation here, on this row here. I'm going to borrow euros, and I'm going to use the euros to buy British pounds, pound sterling. So I'm going to be dividing, right? If I have 10 million euros, I'm going to divide by this price to get the quantity of pounds. So I erase this line, sorry. So you have 10 million euros divided by 1.1555 euros per pound, right? And then I'm going to and then I'm going to translate it to US dollars. Okay, so how am I going to do that? So I have pounds. So if I look at here, I'm going to sell pounds for US dollars. When you sell something, you always multiply by the rate. So maybe that's something to also pay attention to. That may help you. When you buy, you will divide by the quote. If you sell, you will multiply. Multiply by the quote. Okay. So in this case, we have British pounds that we bought, so we divide, and then we're going to sell it for dollars, so we multiply by 1.5386. And I'm going to correct this. Sorry, this should be buy cheap, sell expensive. Intuition. Because we're borrowing the quote currency as opposed to the base currency. All right. So that's exactly what I wrote here, right? You started with 10 million euros, you converted to British pounds by dividing by the price of pounds in terms of euros. And then we multiply by 1.5836 because we are selling it. We're selling the pound for dollars. And in the end, you get 10 million times 1.332 US dollars. The reason why I wrote it this way is because if you look carefully, it's as if we are combining two exchange rates, right? If you're looking at these two equations, sorry, this equation, this fraction and this fraction, the pounds, the pound should go away, right? Because 1 over 1.55 divided by 1 is just 1 over 1.155, right? So the pounds units go away. So we have essentially constructed an implied dollars per euro exchange rate of 1.332. Agree? All right. If we take the inverse, 1 over 1.332, we get an implied euros per dollar exchange rate of 0.75. Agree? And now we want to compare 0.75 to the actual quoted direct quote, which is this line here, 0.7638. So essentially, what are we doing, right? Whenever we do triangular arbitrage, as I said before, we're comparing an implied exchange rate to a direct quote exchange rate. The direct quote is 7.66, and the implied quote is 0.75. So because there's no bid-ask quotes, it should be obvious that there is free money on the table, right? I'm going to try to, in this case, buy low, right? Buy low and sell high at 0.7638, right? Buy at 7.75, sell at 7.68. All right, so yes, so you should get free money if you so this should give you exactly this amount of profits, right? 10 million times 1.332 times 0.7. This is the final step, right? This is the final step to convert back to euros, right? So this amount, this amount is greater than 1, right? 1.332 times 0.768, convince yourself, greater than 1. So 10 times something greater than 1 is greater than, right? 10, right? 10 times something greater than 1 is greater than 10. All right, so to summarize again how to approach this question, as I suggested in the slides, the previous slides, either choose one of the strategies, borrow the base or borrow the quote. If you borrow the quote, just the interpretation is different. You're trying to buy cheap, sell expensive. If you're borrowing the base, you're buying low, selling high. In this case, we're buying cheap, selling expensive. And the way the intuition from doing it, from breaking down the conversions, is to essentially compare an implied quote to a direct quote, currency quote. So in this case, I showed you that we are implicitly deriving an implied exchange rate between euros to US dollars, which is not here, right? I mean, it is here, but you can get it from these two quotes, these other side quotes, top and bottom quotes. And taking the inverse, we can compare that number with the direct quotes, right? 0.75 to 0.76. Again, because there's no bid and ask quotes, it should be very, very clear that two different prices will give you free money, right? Buy low, sell high, or sell expensive, and buy cheap. So using the final conversion, right, we can exploit this price discrepancy. And you can see that this multiplication here will give you a number greater than 1. And so multiplying some number greater than 1 times your borrowing amount will give you more than what you started with, and therefore give you free money, right? So this has to be executed instantaneously, which you can with code and so forth. So yeah, this is free money if you see it. The final 2 tips, right? When you think about quotes, just remember whenever you're buying something, you're going to be dividing, because you're dividing by the price of something, right? If you're selling something, you multiply by the price. Again, it should be obvious, right? When you think about stocks and bonds, but when you talk about currencies, it gets a little bit confusing. Okay, comments, questions on problem set 2.1. All right. So 2.2 is just a testing of your ability to implement compounding interest conversions, okay? It is not in any sort testing your fundamental finance knowledge, okay? It's just making it a little bit harder just because you have to recall maybe some previous knowledge. Okay, so rather than read you the problem, I'm going to summarize it for you here. So they give you an exchange rate. So remember, whenever I give you an exchange rate in this fashion, Euro/USD, that means I'm giving you the price of euros in terms of US dollars. Okay, so E is the price of euros in terms of US dollars of 1.2834. Same thing for forward price. So remember, the forward price is not the price of the currency that you want to buy today. It's the price of the currency you want to buy sometime in the future. And usually there's going to be an associated subscript here of 0.5, referring to the future time I'm going to buy this underlying currency. So F underscore 0.5 refers to the future price of the euro at a price of 1.2779 US dollars. Okay. And 0.5 is 6 months, half a year. And lastly, you're given domestic deposit rates of 3.125% and it's per annum. And your job is to realize that you're supposed to apply the covered interest rate parity, but there's a problem. You're given a per annum compounding annual interest rate, but you have a 6-month forward rate, right? And so naturally, as financial experts, you should know that if we're dealing with annual compounding, there's a way to convert annual to semi-annual, right? And the intuition, of course, is just there should be the equivalence between semi-annual compounding and annual compounding, right? Due to, again, no arbitrage, because the cash flows must be the same, right? Equivalent cash flows, that means equivalent price. Okay, so the third bullet point. This is what we want, right? We want to apply the 6-month covered interest rate parity with R 0.5 and R star 0.5. Again, F over E is just reducing that 1 minus F minus E over E, right? The E over E cancels out with the 1, so all you're left with is F over E. Okay. The next step is realizing that there is a way to convert semi-annual compounding to annual compounding. What that means is that if I decide to put my money in a 6-month deposit rate and I keep it in there for another 6 months at the same rate, that should give me the same return if I put my money today and hold it for 1 year. Do you agree? That's just law of one price, right? Same cash flows, therefore same price. So that's exactly what I'm doing here. 1 plus R 0.5, which I don't know. I'm trying to solve for this, but I do know R1, right? That's given to you. That's this thing. Now, right? So putting in my money in the deposit rate, rolling it over for another 6 months for a full year should give me the same returns if I put my money in a 1-year deposit and I take it out 1 year later. So that's what this equivalent, this is what this equal sign means, right? Those two cash flows must be the same, and otherwise arbitrage. Solve for R 0.5 just means taking the square root of both sides and subtracting 1, right? If you want to do that, but you don't need to. I think it's easier if you just take the square root of both sides for now. So taking the square root of both sides, you get this equation. So hopefully you agree that a square root is just to the power of 0.5. Yes. And we can also do the same for R1, R star, R1 star, right? Cool. So we know R1, right? We plug in R1 here, and we are trying to solve for R1 star. Yeah, R1 star. Yeah. And solving for R1 star gives you this equation. I'll leave the algebra for you to do on your own. And you should get an answer around 4.01%. Okay, so again, the trick here is here, right? Understanding how to convert from semi-annual compounding to annual compounding. And yeah. And being able to substitute out annual compounding interest rates with semi-annual compounding interest rates, and then you can solve for whatever parameter that you're missing. Comments, questions on this question. So again, to big picture, it's just asking you to apply the covered interest rate parity with the inputs, but there's a trick. The trick is you're giving a different maturity, right, between interest rate deposits and the forward contract. So you need to do some interest rate compounding conversions. And then that allows you to apply the covered interest rate parity appropriately, right? Remember that it's talking about this, it has to be the same time horizon. Once you do that, it's very simple. Just plug and chug, solve for whatever missing parameter you have, and you're done. Okay. Lastly, hopefully it should be simple too, because it's just the same thing. But now we have bid and ask quotes, but you should also be super experts now to do this kind of question. So let me give you context. Let me give you some context. Oh, there's 4 questions. Okay, never mind. Okay, I'll go over this question fast. So CIP with bid-ask quotes, just like any sort of assets, including bonds, you can get bid-ask quotes for bonds as well. So you can think of 3-month deposit rates as a bond. In fact, it should be interpreted as a bond. Okay. And with bond prices, you naturally also have bid-ask quotes, right? And therefore, you can interpret bid-ask prices also with bid-ask yields. So that's what I have here, bid-ask yields of different currency deposit rates. Okay. All right. So CIP with bid-ask quotes is just like triangular arbitrage with bid-ask quotes. You just have to go through the arbitrage steps and make sure you're using the appropriate ask or bid price, depending on whether you're selling or buying the foreign currency, right? And also interest rates. So the intuition for interest rates is the following: if you're going to borrow from the bank and you want that quote immediately, the bank is only going to lend you at the higher quote, right? So if you're going to borrow, you're going to borrow the higher quote. Borrow at interest at higher interest rate. And then if you're going to lend, you're going to lend it at the lower interest rate. It's the same intuition as buying at the high price and selling at a low price. Okay. So I outlined the intuition. If you don't quite understand bid-ask quotes, just to refresh your memory, you can think of these quotes from 2 different perspectives. You can think of it from the market maker's perspective, right? If it's the market maker, then bid is they're buying from you, and they always buy from you at the lower price. And if they're going to sell you something, they're going to sell you at the ask price, the higher price, right? Here, good. Market maker willing to buy. So that's the low price, right? That's the lower price. And then market maker is willing to sell the higher price, the ask price. All right, if that's not intuitive to you, of course, you can think of it from the trader's perspective. The low price, the bid price is the price you can sell something you can immediately, and the buy is the price you can, sorry, the ask price is the price you can buy something immediately. So you, yeah, as if your counterparty is trying to gouge you, right? There's no negotiation. You just take, you're a price taker, right? So if you want to sell something, you have to sell low. If you want to buy something, you have to buy it expensive. Okay, so the trick is just another trick, right? With interest rate conversions. You are given the annual percentage yield. So this is just, sorry, you're given yes, you are given the AP. Yes, you are given the APY, right? So in this question, you're given the annual percentage yield. And you need to convert it to the periodic return for 3 months, so a quarter. That's why 0.25 refers to. Okay. So hopefully you understand, just like in the previous question, right? We're converting an annual percentage rate to a compounding periodic rate. I think that's called APR if you multiply by the number of periods. So 3-month APR, yeah, divided by 4 gives you the periodic interest rate. Right. So you're given the 3-month APR, I believe, and you have to divide by 4 because there's 4 quarters in a year. And you have to take it to the 4th power, compounding it 4 times, and that will give you the annual percentage yield. So this shouldn't be new. Okay, this is all review of corporate finance. And then solving for this periodic rate, straightforward. It's just algebra, right? And yeah, so that's what I did here. I've just converted those 3-month APR, so APYs, to periodic rates. Okay, that's all I did. So remember, I'm looking at this table here. Okay, these are 3-month APRs. These are compounded annual percentage rates, yields, and I'm converting it to 3-month periodic rate to apply the CIP, covered interest rate parity. In the question, you are given 3-month APR. Okay, so that means you have to divide by 4 to get the quarterly compounded annually, and then substitute in here. Sorry, you're given APY. Sorry, I got it backwards. You're given annual percentage yield, and you're solving for this, okay, which is just the periodic rate. And this numerator has a name. Okay, it's called APY. Sorry, APR. I'm getting confused. APR is what you're usually given. Anyways, dividing by APR by the number of times it's compounded in a year gives you the periodic rate. All right, so just to recap a little bit, you're given these quotes, which are annualized, okay, and I want to convert it to periodic 3-month returns, which I can, realizing that there's an equivalency between annualized return and compounding quarterly, and all we have to do is solve for this term here, and you'll get the periodic return for 3 months. Okay? And just realize that there's 4 quarters in a year. Yeah. All right. So it's probably best to approach this question by just outlining the steps first, and then thinking about whether or not you should use bid and ask. All right. So in this question, you are already given all the inputs, right? You know, yeah, you know F, you know E, and you know F. You know the R's, you know the F, and you know the E, and you're just checking if there's a violation. And the question, right, is whether or not to use bid and ask. And I'm just going to outline the strategy that's the correct answer, okay, and just walk you through why it's ask and why it's bid. So I'm going to show you that if you borrow Japanese yen, the domestic currency, and try to exploit higher interest rates in the United States, you will get arbitrage profits. Okay, so in this case, R is the yen, and R star is the USD. So if you follow the steps from our slides, we're going to start by borrowing E amount of the domestic currency. Okay, so I choose E because it's going to make the math easier. So I borrow E, and once I borrow E, I create a liability, right, of 1 plus R Japanese deposit rate times E. Now the question is, which E should I borrow at? Should it be E ask or E bid, right? And you can tell from the next step. So if you're going to borrow some money and use it to buy something, you're going to buy at the more expensive price, right? So you need to borrow the ask in step 1. So based on step 2, you know you have to borrow the ask. So we borrow E ask of Japanese yen, use it to buy $1 for this price. Yes. So we lost our E, right? So now we have $1. And the next step is to loan it, right? To lend it out so that we receive 1 plus R USD. So because it's a liability, it's going to be at the higher rate. So we're going to pay at the higher interest rate. And our loan is going to be a return at the lower rate. So it's going to be a bid. So far, so good, right? So step 2, so summarize again, step 2 tells us we're going to buy something. So when we buy something, we have to borrow the amount at the higher price. So we borrow at the ask. So E amount of ask. We take that E amount of ask and we buy 1 unit of US dollar. And we're going to use that US dollars to lend it out. So when we lend something, especially to a market maker, we're only able to lend it out at the lower interest rate, right? So it's going to be a bid return, as opposed to a liability, which I borrowed, it's going to be at the higher rate. So I can only take the higher rate. Okay. All right. Step 4, I think it should be clear, right? Based on last week, when you have such a scenario, there's our source of FX risk comes from step 3, right? Our return is risky. And we need to engage in a forward contract to eliminate that risk, right? In other words, we want to sell it off, right? We want to get rid of it. And so we want to sell precisely that amount, right? 1 plus R USD bid in exchange for this price, F. So because we're selling, we can only sell at the lower F, right? The bid. So sell low. All right, so our final equation, you can memorize it or you can derive it on the exam. I don't care. It's probably more fun if you derive it on the exam yourself. But you can memorize it. But that's the formula that you can use if you ever need to borrow Japanese yen and borrow domestic and lend foreign. Okay, so if you think that's the strategy that yields arbitrage profits, you just plug in the numbers in these parameters and check if it's violated in the direction that's right, in this direction. And indeed it does, right? I plugged in the numbers for you already. Okay, and done. You have arbitrage profits. All right. So the takeaway here is number 1, the strategy that I outlined for you is exactly on the slides. I've outlined it all for you from last week. The only difference now is I've attached ask and bid prices, right? And the logic here is if you're going to lend out interest rates, you have to lend it out at the lower interest rate. And if you're going to borrow something, you have to borrow at the higher interest rate, the ask interest rate. And then the buying and selling currency is the same logic as last week, right? You buy at the higher price and you sell at the lower price. Okay, comments, questions. So I believe my solutions online also gives you this equation for the other direction. So I'll let you look at that yourself. I'm not going to walk you through it here. All right, last question on the problem set. It's supposed to give you a little bit more intuition of what CIP is actually doing. As I kind of emphasized last week, the takeaway from CIP is it's just an equation to price the forward contract. And this is kind of, this exercise is kind of just reinforcing that intuition that it's actually used to price forward contracts. So I'll walk you through it. So the setup of this question, I'm going to summarize it, but you're a wine seller and you're trying to hedge against fluctuations of the price of barrels, which is quoted in euros. So you're a winemaker in California. Okay, your domestic currency is dollars, and you need to buy barrels in the future, which is quoted in euros. And you want to hedge against future fluctuations of the euro in terms of dollars, right? And you can't find a forward contract. There's no market, let's just say there's no market that goes that far into the future. Let's say that's 1 year, okay? And therefore, you have to basically find a way to construct a synthetic forward contract with just interest rates. And the exercise tells you, indeed, yes, you can construct a synthetic forward contract with just interest rates between two countries. Okay, so let's just do it together. So as I said, we are a winemaker in US, we're a business in US and America. Our domestic currency is US dollars, and we're going to eventually use US dollars to buy euros so that we can sell our products somehow. Okay, so foreign currency is euros. The exchange rate, this exchange rate is based on what I described here, domestic numerator, foreign currency denominator. So E is dollars per euro. R star is 4.75%, and regular R is 4.25%. So these are foreign and domestic interest rate returns, respectively. Objective, lock in future US price of barrels today, which costs 122 euros in 1 year. Okay, so you have a future expense of 122 euros in 1 year. And you don't need to, the point is you don't need to have 122 euros today. You only need it 1 year from now, okay? And you don't want to buy the barrel today because assume you have no inventory. All right, so how would you go about, constructing a synthetic forward contract? So the idea here is just to go backwards from this setup. Okay, so instead of going from borrowing and then going down to checking if there's an arbitrage, we're going to go from here back to the top based on what we need. Okay. So first, we noticed that there's we need an inflow of 122 euros to buy a barrel in 1 year. Okay, you don't need the euros today, so what we can do is deposit some amount of money in a foreign bank account, earn some interest, and then have 122 euros at the end of 1 year. Right? You don't need 122 euros today. We need something less than that because we could deposit some euros in a euro-denominated bank and get 122 1 year from that. So how do you figure out how much money you need to deposit in a euro bank? You simply divide 122 by 1 plus R star, right? That's how much you need today to be deposited in the bank to get 122 in a year. So today you only need 116 euros. Correct? All right, in terms of US dollars, we just multiply the foreign currency by the exchange rate, which will give us how much dollars we need today, 149. Okay. So far so good, right? That's how much domestic dollars we need. All right. So we need that 116 euros, and that means there's going to be an outflow of USD of an exchange rate of F. Okay, and so we're not going to actually use our own money. Okay, 149. We're not going to use our own money. We're going to borrow it today, so $149 today, and we're going to owe 1 plus R. Agree? 1 year, sometime in the future. So therefore, our price is just 149 times 1 plus R, right? That is our future price. So that's 156. So based on the steps I outlined, I've essentially constructed my own forward exchange rate, right? So that's again, the big picture idea. CIP, primarily used to price forward contracts. Why? Because with interest rates and the spot exchange rate, you can borrow and lend from different banks, and then basically create two cash flows. One going out, one going in. That's exactly what a forward contract is, right? There's a exchange of cash flows. And in this case, one exchange is US dollar and the other exchange is euros. That's it. Okay. So we've solved for our synthetic F. That's done. So precisely what are you going to do? You're going to borrow 149 today, owe 149 times 1 plus R, and you're going to use that 149, convert it to euros, put euros in a bank, and make 1 plus R star, right, in the future. And so 1 year from now, you will have precisely 122 euros at a price of $156. Yeah. That's it. So I guess the punchline should be exchange rate of 156 US dollars for 122 euros. And I'll let you calculate the exchange rate. Yourself. All right, comments, questions? All right, yeah, I'll get to that later today. So let's start this week's lecture. So I can answer questions during the break. So I need to move. I'm about 10 minutes late. So let me see. Our objective today is actually quite short, but I kind of want to walk you through it very slowly because the intuition is not easy to pick up. Okay, as well as the simple algebra. We're going to use some pictures today. It's a big picture. What are we trying to do? We're trying to repurpose the covered interest rate parity as a way to price essentially returns on foreign currency. Our future E minus E over E. We need a way to predict what future E minus E over E should be. And we're going to borrow the covered interest rate parity and use it for those purposes. But we need to impose some assumptions so that it can be a formula that we can use to kind of predict what E should be, essentially. All right, so once we impose a couple of assumptions, we will end up with what's called the uncovered interest rate parity. Okay, this is going to be, it's called uncovered because after imposing those assumptions, there's no need to engage in a forward contract. And so that's why you are intentionally exposing yourself to fluctuations, potential fluctuations of the future value of E. Okay, that's why it's called uncovered. And then we're going to talk about how we can use this new formula, the new UIP, to make predictions about how E should move in response to changes in R and R star, or something else, which I'll get to soon. All right, so it's called the asset approach because we're basically focused on one dimension of investor preferences. So if you've taken corporate finance and you've learned about capital asset pricing model, you will know that they assume that investors are risk averse. Namely, they have some sort of quadratic utility function, something like that. We're going to make our lives extremely simple, okay? And in order to use this equation as a pricing model for exchange rates, we have to impose what's called a risk neutral investor assumption, okay? So that means it's not a risk return trade-off, it's just a risk maximization problem now. I mean, sorry, return maximization problem. So to review, in your corporate finance class, in your capital asset pricing model, you focus on several dimensions of investor preferences, right? Mean return is important, right? Average return over time is important. How do you quantify risk? How do you measure it? You can think of it as the variance or the standard deviation of returns of the underlying stock, for example. You can think about kurtosis or skewness of returns, fat tails, all that stuff is all different dimensions of risk. And another dimension is liquidity. Is it easy to sell something immediately, right? In this class, for pricing currencies, to make our lives easier, we're just going to be ignoring these preferences, okay? There's different ways to model this, and we'll just attach terms to the UIP equation. They're called risk premia terms, which we'll talk about later. But just to make our lives easier and focus on intuition, we're going to be just assuming that investors only care about average returns. Okay. And this will be our primary mechanism to allow UIP to be true, okay, which I'll get to use, which you will see soon, okay. Okay, I'll talk about that soon. All right, so just to review, the terms that you already saw in your CIP equation. So you already are familiar with R and R star, right? They're just a return on deposits, and we typically assume that bank deposits and bond-like securities have fixed returns. Yes, R is deterministic. We know how the coupon payments are every year, right? Assuming that it's no default risk. And the same thing with bank deposits. But foreign currencies, stocks, and so forth are different. The returns can fluctuate, are unpredictable sometimes. And therefore, we need a way to, summarize its returns somehow. And we usually do it in statistics and finance in terms of its average, right? The expected value. All right. So that's interest rates and versus changes in currencies. Okay, so again, when we're thinking about future E, so I'm going to use E hat E to indicate average, the expected future return, future value of the spot exchange rate. Okay, so this term is called the expected future spot exchange rate. E hat E. E meaning the E indicates expectation. Okay, just remember, so the intuition is I emphasize expectation because it's about forward-looking beliefs. Okay, so it's imagine I can aggregate all traders in a market and collapse their beliefs into one centrality, right? Which is what E hat E is. So the hat indicates it's estimated. Okay, so E hat E estimated expectations about the future spot exchange rate. So E hat E minus E over E is an average return on the foreign currency. Right? So this is at expected expected return on foreign currency. Right, it's just like stocks, right? Stocks is expected return on an Apple share. Here we're doing expected return on a foreign currency. So a higher return on the foreign currency means that the foreign currency is getting stronger, but you can also say, well, from the perspective of the home currency too, it's expected depreciation of the home currency. Same thing. Okay. Expected. So sometimes it's this term, this return is substituted with appreciation, right? And you can think of it also as expected depreciation of domestic currency. Yeah. Concur? All right, so far so good, right? I haven't introduced to you anything yet. I'm just making sure that everybody gets the statistics right, so that when you see the notation, it's not confusing. Okay, so my job here is just to make sure again that everyone understands what an average is, not from the sense of like a sample average. I'm talking about actual average if you know the state of the probabilistic state of the worlds. So let me show you what I mean. So suppose you have a currency, a spot exchange rate E, and the future value can take, let's just say there's two states of the world. This means there's only two possible worlds that can occur after today. Okay, say for one day. Let's just say it's 50% chance that it increases in value and a 50% chance that it decreases in value. And let's assume that it can increase by, let's just say it goes, let's say it's 1 and -1. And yeah, so my question here is what is so this should be not E, it should be E prime. So I'm going to use the prime to indicate future realization. Okay, so we don't know what E is going to be. E prime is going to be. So I emphasize here. Random variable. So I hope that's not. Do you know what that means? Say something if you don't. Okay. So it's a variable that's you don't know what is it has multiple realizations in the future. Okay. And in reality, we don't know what that is, usually. But for my situation, we know precisely that there's only two states of the world. And therefore, given this fact, I know exactly what the average looks like and what its variance looks like and so forth. Okay, because I know it's only 50-50. So in this case, in the scenario in which I know exactly how E can evolve, right? Then I can calculate an average. And we use this notation in statistics and also economics, right? Expected value of E is simply the weighted average, right? Of those likelihood of those states, right? 50% times 1, right? Plus 50% times -1. Concur? It should give you 0, right? I know this is nonsensical, but just for simplicity's sake, just assume that let's assume that it's 0 is okay. Agree? And just reviewing basic statistics. All right. Then you also know what this looks like too, right? Yes, you guys should know what that looks like too. So just to review, it's the weighted meaning of each possible value, right? So we subtract the mean. So it's 0 and we square it, right? And we also, let me use percent just to be consistent. 50% times -1 minus 0 squared. Concur? Okay. So as I will explain later, risk neutrality means I only care about this risk, and also I do not give anything. I don't care about variance at all. I totally ignore it. Okay. All right. Yeah. When I talk about the assumptions, I'm gonna give you example how critical that risk neutrality assumption really is. All right. So if we now you kind of understand, I hope you, based on this example, you understand that expected value is basically a linear function, right? And I can just apply this expected value on my CIP equation. And after swapping out F for E hat E, right? So let me show you what I mean. So if I have 1 minus R, so 1 plus R equal to 1 plus R star, and I'm gonna do F E prime over E, right? So now I'm not going to engage in a forward contract. I'm just gonna be exposed to the risky realization of future E, okay? And I'm going to take expected value on both sides. Agree? Now, R is deterministic. That means there's no different realizations for different states of the world. So constants are just constants. So the E bracket doesn't do anything. So it's just 1 plus R. And because 1 plus R star is also a constant, you can bring it out of the E bracket. So therefore, and you can also factor out the E, the division by E. So it's just E prime divided by E, right? And the notation I gave you about E expectation of E prime, right? It's just E hat E. E hat E divided by E. So this is the uncovered interest rate parity. Okay. And we can use this to figure out how E can move, right? That's the whole point. We want to know how E changes when other parameters change. And we will go through examples of R star, and E hat E. So for now, just think of E hat E as an anchor. Okay, so I'll remind you again. Just think of it for now as a constant. I didn't tell you what exactly E hat E is, just that it's a representation of beliefs. Okay, and you need an additional assumption to kind of make sense of this equation. All right, so yeah, so this is just going over understanding how changes in currency value given this expected depreciation of the home currency. So I'm gonna skip this and just go directly to what I wrote earlier, right? This is the covered interest rate parity. We can get this simplified version, right? If we multiply everything out and omit the R star times F minus E over E, because small numbers times a small number gives you a very small number. Sometimes you'll see this because I'm using graphs, and it's easier to see how the graphs change when I change certain parameters. And again, just to make the distinction, to emphasize the distinction between CIP and UIP, CIP only requires one assumption to be true, and that is there's no arbitrage. If there is, it shouldn't last very long. And so CIP should be very robust. And when you do the case study, you can empirically verify it yourself. It is almost always true. All right. The difference now is we have this term, right? And this requires, swapping out F for E hat E requires two assumptions. That, let's see. Let me go over the assumptions first. All right, here. And then I'll go over the previous slide. So the key assumptions are the following. Number one, financial markets are efficient so that everyone holds the same information about E hat E. So remember what I said, that E hat E is supposed to be a representation of everyone's beliefs about the future, right? If markets are efficient, or in other words, there is no distinction between private and public information, and the market somehow aggregates the universe of information, then on average, people should be fairly good at predicting the future. That's basically what perfect information or efficient markets means. The market incorporates the universe of people's beliefs, and our beliefs are more or less on average correct. Okay, that's what these, you can already tell that things are already require very strong assumptions, right? Okay, so that's number one. You have to have efficient markets. You have to have efficient aggregation of information. There's no distinction between private and public information sets. Everyone has the same information, and if so, then people on average should be accurate in their prediction of what E hat E should be. Okay, that's number one. So number two, investors are risk neutral and only concerned with the level of E and not the risk around the expected value. So what that means is that investors should just focus on violations, or investors should only focus on the violations of UIP and have incentives to engage in carry trade to close the gap, right? The idea here is that if there is a gap, then there is a positive expected value from engaging in carry trade. So carry trade just means borrowing low interest rates and lending out at high interest rates and being now exposed to potential fluctuations of the underlying exchange rate in the future. Okay, so to emphasize, when I say carry trade, borrow an interest rate, lend out at an interest rate, and be exposed to FX risk, specifically future FX risk. Okay. The reason why you're exposed is because you have expectations now in your equation, right? In your payoff equation. So to summarize, in order to swap out F for E hat E, you have to believe markets are efficient at aggregating the universe of information, and everyone has the same information set. Okay, no asymmetric information. There's nobody withholding information from the markets, and therefore people are on average pretty good at predicting what the future value should be. All right, step two. Now you have to have an assumption to incentivize investors to actually act on violation of UIP. And they're only willing to act if expected value of carry trade is positive. Expected value of carry trade is positive if CIP is violated either this way or the other way, right? There has to be an inequality for incentive, for there to be an incentive. All right, so the big picture is we have a reason to ignore F, right? We can just swap it out with expectations. And number two, we have a market mechanism to restore the parity, right? The UIP, the uncovered interest rate parity, but it relies on the assumption that investors are risk neutral. But there's many reasons why that may be problematic to you already, right? So let me give you an example, and then we'll take a break. Why is this a problem? Well, consider the following thought experiment. Suppose I offer you two types of gambles. So gamble is just like a coin flip. So gamble one, you have a 50% chance of earning $1 and 50% chance of losing $1. Okay, that's your first gamble. Gamble two, you have a 50% chance of winning $1 million and 50% chance of losing $1 million. Can you tell me what the expected value of gamble one is? Can someone tell me what the expected value of one? So what's the expected value of 50% chance earning $1 or 50% chance and 50% chance losing $1? Zero. What about gamble two? Yes, also zero. Very good. What about the variance of gamble one? So this one's a bit tricky. But once you see it, it's 50% of 1 minus 0 squared, right? Plus 50% 1 or negative 1 minus 0 squared, right? So that should be just 1, right? What about the variance of gamble 2? You don't have to do it. It's a gigantic number, right? I'll write it for you just to make sure you agree. 1 million minus 0 squared plus 50% negative 1 million minus 0 squared. So my question to you now, if you're a risk neutral investor, which gamble would you prefer? Remember, you're a risk neutral investor means you don't care about risk. So which one would you prefer? You're indifferent, right? You're indifferent. You don't care if you get gamble one, gamble two. They're the same to you. Yeah. So you can already see there's problems with these assumptions, but these are the sufficient assumptions you need to be able to use this uncovered interest rate parity. So things like, for example, country default risk, right? That's something we didn't talk about yet, but there are ways to augment UIP to offset, restore parity for UIP. Okay. All right, so let's take a 10-minute break. I'm gonna pass out quiz again. You have the end of class to submit, so you can talk to each other. I don't care. Okay. The whole point again is just to see what you guys are absorbing in class, and if you do well, you get a return, right? You get some extra credit potentially. All right, so let's I'm afraid I may run out of time, so I'm gonna try to speed up a little bit. So just like the CIP, there is a simplified version of it as well. So the only difference here is I swapped out F for E hat E. Okay, so I will use both versions. So this long form version, when I'm talking about actual carry trade expected returns or profits, right, over a certain period, I'm going to use this simplified version for plotting purposes. So people understand different concepts in different ways. Some people can just deal with the formulas, others need pictures, and some other people need words. So I will try to give you all three ways to understand UIP. So there will be some drawing today, and therefore I need to use a simplified version for the sake of to understand which parameter changes with respect to other changes in certain parameters. All right. So I kind of want to show you what I mean by your beliefs are correct on average in the future. So remember, swapping out F for E hat E means that our expectations or beliefs are good enough to forecast future spot exchange rate, right? And the best way to show you this is to use a graph and look at a timeline to see how the E should evolve over time and approach to our expected value for future E, okay? And what I'm going to do is take this equation, this simplified equation, and just multiply it through with E and rearrange it such it looks like this, okay? And I'm gonna do two scenarios. I'm gonna do a scenario in which this difference is positive and also when it's negative. And then we're gonna try to understand how E has to evolve over time. Okay. If that doesn't make any sense, it will. So I will write this equation up here just to make sure. That's right. Is that right? Yes. Sorry. Yep. Okay. Okay, so let's go ahead and as I said earlier, we're going to think of E hat E as some sort of anchor. We're not going to change our expectations with respect to anything. It's just something that's fixed. Okay, our beliefs about future is fixed. And I'm gonna denote this on this plot at this point here. So let me tell you what the axes are. So the axis, the y-axis is the nominal exchange rate or the spot exchange rate E. Okay. And the x-axis is time. So I'm gonna say time is perhaps 90 days. So suppose our forecast into the future is only for 3 months. Okay. Our expectation about the future spot exchange rate is anchored. Let's draw some dashed lines here. I'm going to call this point here E hat. All right, case one, R star is greater than R. So when R star is greater than R, that means that this term here is positive. Correct? If the right-hand side is positive, then the left-hand side must also be positive. And if our beliefs about the future spot exchange rate is anchored at this line here, and this is, for example, the origin, then this current spot exchange rate E, just regular E, must be above E hat E. Agree? So I'm going to use E naught to denote the spot exchange rate at this precise moment. So let me say that again. In this scenario, in which we have in which we have interest rates, foreign interest rates greater than domestic interest rates, and assuming our expectations about the future spot exchange rate is fixed or anchored at some value here, it's arbitrary. I just chose this randomly. This equation, the UIP equation, tells us that if R star minus R is positive, then E minus E hat E must also be positive. And if E hat E on this graph is at this point here, then the spot exchange rate E must be above it, right? A big number minus a small number gives us a positive number. Cool. Now, what does being right about our expectations mean about the future spot exchange rate? If our beliefs are accurate, that means that over time, the spot exchange rate needs to evolve in such a manner, right? Because our beliefs are correct. If the current spot exchange rate is higher than our beliefs, it must somehow converge in the future. So that's what it means to be correct, okay? So in other words, this gap here is just this R star minus R times here. So in words, what is this saying? This is saying that we must have domestic appreciation, right, in the future. So if we have an interest rate differential that skews towards foreign interest rates, this graph tells us that we must have future domestic appreciation. So kind of get that burned into your skull, into your brain, okay? So in order for UIP to be true, if there is an interest rate differential that's biased towards with preference for foreign interest rates, then our domestic currency must get stronger over time. Otherwise, UIP will be violated. All right, other direction. Again, I'm just going to arbitrarily choose a point to designate our anchored beliefs about the spot exchange rate. I'm just going to choose this one. And also just call it E hat E for redundancy. This equation tells us that if R, now regular R, domestic deposit rates are greater than foreign deposit rates, then R star minus R must be negative, right? And based on this equation, the left-hand side must also be negative. And therefore, our spot exchange rate must be below, right? Below E hat E today, right? It has to be below today. Again, if we have perfect information, we are accurate in our prediction about what future spot exchange rate should be, then the spot rate should eventually approach our beliefs. Right? So in other words, if you observe interest rate differentials with larger interest rates domestically, then we must have domestic depreciation over time, right? E must increase. So yeah, over time, in order for this difference to exist, right? In order for there to be a gap between interest rates, there must be equivalent gap between expectations and the current spot exchange rate. And over time, because we're right about it, E must eventually evolve in such a manner that approaches E hat E. So this is sometimes called rational expectations. Just means that, yeah, our beliefs are more on average. If you aggregate everybody's information sets, then on average, we should be pretty good at forecasting. That's that's subject to debate, of course. So, on average, I think I'll emphasize on average, our beliefs are correct. So hopefully it's intuitive why E has to go in the direction it must go, right? Because otherwise you can get, on average, positive expected returns from a carry trader's perspective, right? If E doesn't depreciate enough or E doesn't appreciate enough, depending on which interest rate is higher, then there's a gap, right? And carry traders will want to come in and close the gap by changing the price of E in a direction. I'll show you. I'll show you. All right, comments, questions on this idea of domestic future appreciation, domestic future depreciation, given the interest rate differential direction? Okay, so let's look at this different graph now. So let me put in the UIP equation here so that we can analyze it together. In this graph now. Okay. So this is the graph we'll be primarily working with throughout this class, in which we have on the y-axis the spot rate, the spot exchange rate, and on the x-axis the UIP equation or interest rates. So this should be equal to R. Right? This is just the simplified uncovered interest rate parity. R equals R star plus E at E minus E over E. Right? That's this equation here. Alrighty, so we want to characterize the relationship between E and R so that we can understand, without thinking too much, how this graph should change when we change certain parameters. So what we should do is just increase or decrease E and see what happens, right? So maybe if I wrote this equation, simplify a little bit more, be clear. So I can write this as R star equals to R plus E hat E over E minus 1, right? Then it's just one expression, right, that we have to care about. Okay, so if we increase E, sorry, maybe I'll increase R. Okay, so let's just start at this E here. And I increase R. That means this entire right-hand side is now greater than the left-hand side. So I need to do something to E to make it equal again, right? And I can do that by increasing. Sorry, more positive. Yes, increasing E. Did I rewrite? Oh, wait, sorry. Wrong. I switched the R's. I'm sorry. Should be R. Sorry, stuff there. I was really confusing myself. Okay, now it makes sense. Let me erase that. Let's try this again. So we fixed E. Sorry, if we fix for a given E, if we increase R, then the left-hand side is greater than the right-hand side. We need to make the equations equal, and the only parameter we can change is E. So E has to move in a way that equates these two sides, and we can do that by decreasing. Agree? Because decreasing the denominator increases this entire fraction, right? And that's how we restore equality. So there is a negative relationship between E and R. Agree? So maybe I'll write it down. Increase R makes left-hand side larger. Can decrease E to increase E hat E over E. And until parity is restored, right? So all else equal, if you want UIP to be true, and if I decide to increase interest rates in a direction, there must be an opposite direction change in E such that the parity is restored. So there's a negative relationship between E and R. So what this is meaning is if I have a very high E, I must have a very low interest rate. Which makes sense, right? So just think about who controls interest rates, central banks. How do they decrease interest rates? They print money. If you print a lot of money, your money's pretty much it's worth a lot less than before. And a high E represents a very diluted currency, right? So that's the intuition. So very high E, very low interest rate. This is a high E, low E, very low E. So far I didn't present any intuition, right? It's just understanding the algebra and then just translating that to pictures. So to summarize, I'm plotting E against R. We know the relationship between R and R star, E hat E and E, right? From UIP. And all I've done as a thought experiment was just to change R in the upward direction and see which direction E changes. And we find that there's a negative relationship between E and R, and therefore it's a downward sloping curve in this graph. All right, so same axes in this graph. Now I want to show you how to think about this from a policy analysis, okay? To do your policy analysis. So you have a downward sloping curve, which represents the UIP relationship, right? The uncovered interest rate parity. I often just write R equals R star plus E hat E. And it's E over E, just to emphasize what it is the curve represents parity, okay? So every point along this curve represents a point in which there is an equilibrium. Okay, that means no incentives for carry traders to come in to bid to change the price of the spot exchange rate. And as you will see, we can now kind of analyze this from the monetary central bank perspective if they decide to change interest rates are. So that's what this vertical line represents, is interest rates. This is our link, as you will see, our link to the macro economy. And we'll get to that later. But that's kind of the idea. So if you, from the central bank's perspective, you want to know how E moves when you decide to print money, all you do is shift the curve. And you can kind of see, you can already tell which direction it's going to go, as I already gave you intuition, right? So R prime is my indication for future change in R. If it goes down, you should expect domestic what? going from this point here to a higher E, and we all know higher E means depreciation, right? Depreciation, domestic depreciation. All right, so that's actually the next slide. So let's go through that together, and let me give you the intuition how that works. So just get used to writing the UIP equation over and over again. And we're going to start out with an initial equilibrium. So the intersection here, remember, every point along this curve represents an equilibrium point, meaning there's no incentive for carry traders to come in to change the price of the foreign currency. So for a given R star, this is the equilibrium point, right? No carry traders don't want to do anything. Okay, I'll use E naught to indicate our starting point. Now, if we have an increase in USD interest rates, so we're assuming USD is the domestic currency, there's going to be an upward shift or outward shift of the vertical line. I haven't told you how it's done yet, right? We're just taking for granted that the central bank does this. All right, so just graphically, you should already know where the new equilibrium should be. It's at this new intersection right here, right? This is kind of brainless to do, right? You just shift the curve, whatever the intersection is, that's the new equilibrium. Now I'm going to give you intuition. Okay, what's going on behind the scenes? So what happens is you get domestic appreciation today. So that's kind of the emphasis. That's what happened. There's domestic appreciation today if there is an increase in interest rates. And the intuition is the following based on the UIP equation. Okay. So how do you interpret this? Well, assume expectations of the future is fixed. That means it's anchored. Interest rate differential with greater returns on domestic currency as R increases to R prime. Agree? So R minus R star is now greater than before. So I'll show you that mathematically. What does that mean? That means that that means specifically that R prime is greater than R star plus E hat E. Concur? With R increasing to R star, UIP is now violated. You have, in other words, R prime greater than R star, or R prime minus R star, the gap is now larger. The differential is greater now. From the equilibrium perspective, from the UIP perspective, this is only acceptable equilibrium if there is equivalent capital loss in the future. On foreign currency. So what does that mean? That means that sorry, it should be domestic. You can see that, right? This is our variable. This is our expression that represents capital gain, capital loss on domestic currency, right? Capital loss just means depreciation. So depreciation means E hat E minus E must get larger, right? In order to restore parity. UIP basically says that capital loss must wipe out interest rate differential. Too much text. All right, so that's, you see the subtle paradox here, right? The paradox is today your currency appreciated, right? That's the kind of potentially confusing thing. My currency appreciated today, right? As a result of an interest rate increase, yeah? As you move outward away from the origin, the value is increasing. That's how you should read the graph, okay? R goes from R to R prime. My currency gets stronger. But the reason that it gets stronger is actually going the opposite direction. It's getting stronger so that this term gets larger, right? And the only way this term gets larger is if E goes down, right? So that there is future domestic currency depreciation. So let me say that again, okay? The thing to notice that may confuse you is that you observe a domestic currency appreciation today, but at the same time, you have to get future capital loss in the future, right? The reason is because if you look at the UIP equation, you have to make room for E hat E minus E over E to get big, right? To be large enough to completely offset this increase from R to R prime. So the currency strengthens today so that it has more room, so to speak, to depreciate in the future. That's the equilibrium concept, okay? Currency gets stronger to make room for depreciation. The other direction, as you can try yourself, the currency must depreciate today so that it can appreciate in the future. You can work through the logic yourself, right? Going the other direction. All right, so what you might be more interested in is kind of the mechanical way, like the trader's perspective, as opposed to this theoretical perspective. So from the trader's perspective, it's quite simple. So with R prime, R prime greater than R, UIP is violated and engage in carry trade. What does that mean? They're going to borrow foreign and lend domestic. Agree? But in doing so, they have to sell foreign currency for domestic. This will bid up the price of E today. Bid up the price of domestic currency today, which is E decreases. Right, very simple. Done. So that's how you get E naught to E prime, right? From the trader's perspective. Just simply the fact that you have carry traders coming in and exploiting, trying to exploit, right, this violation of UIP. And they're going to keep doing this until the gap is closed, right? And that requires that the spot exchange rate, this domestic currency strengthening today. Okay. But the bigger picture, the next step is the reason why there's a bigger depreciation today is because in order to make expected returns on currency deposits across the world equivalent in value, you need domestic currency to get larger, depreciation of domestic currency to be larger. And the only way that can work is if something changes today to allow more room for depreciation. So the words I'm just describing is literally just the equation here, right? It's just this equation. Comments, questions? All right, let's try another exercise. Let's try to increase foreign currencies interest rate. So we're looking at R star now. So every time we do this kind of visual exercises, I always have a starting point. Okay, so for the sake of time, I'm just gonna do all this really fast without explaining much. And I will have a starting point here. That's R. That's domestic interest rate. So first things first, I'm just going to I'm going to use just the formula to show you what must happen graphically. So if we look at the formula, and we're going to increase foreign currency interest rate upward. And based on that increase, we know that the entire equation is going to have this inequality. The right-hand side is going to be greater than the left-hand side. In order to restore parity, assuming expectations are fixed or anchored, we must have a change in E to offset that increase in R star. So here we must have an increase in E, right? Because increasing E will increase the denominator and therefore decrease this entire expression and therefore offset this R star. So what that means is that given R, so given any choice of R, if I decide to increase R star, I should have an increase in E, right? So let me say that again. No matter where I start on the x-axis, if I increase R star, E must increase. So this point jumps to some point higher, right? Doesn't matter where I start, the entire UIP curve must therefore shift upwards. So this new curve, I will denote as R equals R star prime as a new equilibrium, like that. Okay. Yeah. So let's walk through both interpretations again. So let's walk through the equilibrium explanation and also the carry traders explanation. So the final equilibrium, of course, is here, right? Is the intersection of the new UIP curve and this E. And we were here before, right? We were here, and then we ended up here. So we must have domestic. So with higher E, we must have domestic depreciation today. So step one, fix expectations. That means E is anchored. Greater interest rate rate on foreign currency. So this is only acceptable equilibrium if interest rate differentials are wiped out. And this must occur through capital gains on the dollar. Sorry, domestic currency must depreciate today so that it can appreciate in the future. Right? Same intuition, right? If it's violated in now preferring with greater interest rates on foreign currencies, carry traders are going to come in and borrow domestic, lend out foreign, and in doing so, they have to sell domestic. Sell domestic. So exchange rates have to depreciate, right? It has to go up, and that allows us to restore equilibrium, right? And doing so, you get a smaller, right? Smaller gap, and that's how you restore the parity. So trader's perspective. Carry trade, borrow domestic now and lend foreign. And in doing so, you have to sell domestic or foreign currency. And therefore, you're going to have domestic depreciation, which means E increases. And that's your new equilibrium, right? At a higher E. So now you can kind of make predictions, right? Or at least you understand how it works with UIP. If you're looking at the exchange rate between Hong Kong and Europe, and Europe decides to cut interest rates, you kind of now understand there's some sort of pressure building up in the FX markets, and you know which directions should go. Yeah. All right, comments, questions on visually representing the UIP curve, UIP equation. How shifting the x-axis allows us to determine the new equilibrium point for E, today's E. How shifting foreign interest rate changes E. And lastly, what happens when we change E hat E? So we'll talk about what actually can change expected future rate to be more precise. But this is just an exercise of understanding the algebra and plotting, simple equations. All right, so again, let's have a starting point. And let us draw just a vertical line again for interest rates. And we have a starting equilibrium point here, right? This is E naught. Now, what happens now is we have an increase in E hat E. So if E hat E increases, this equality will have an inequality, right? In which the right-hand side is now bigger than the left-hand side. If we want to restore equilibrium, we need something, E must change today somehow, right? And to undo this increase, you can increase this denominator, right? So increase E here will undo the increase in E hat E in this direction. So visually, what does that mean? That means I can choose any R. It doesn't have to be this one, it can be this one. If I choose this R and somehow there's a higher E hat E, then we must have an increase in E to offset that change in expectations. So no matter what R I choose, E must increase when E hat E increases. And therefore, they're going to have a shift in the curve upwards. So this is R equals R star plus E hat E prime minus E over E. And the new equilibrium point is here. All right. So I'll walk through the intuition again, but perhaps you have a question about how do I know when to shift the curve and how do I know when I'm just moving along the curve, right? I think that's a question you may probably be asking. Rule of thumb, all right? If I am increasing or decreasing variables that are on the axes, so either E or R, I am going to be moving along the curve. So just like this example here, right? I'm just changing R, so I'm just moving along the curve. There's no curve shifting going on other than this vertical line, which is just literally one number, right? Not a relationship. So rule of thumb, change variable on axes, then move along curve. Otherwise, there is curve shifting. So if you noticed in the previous examples, right, I changed R star, which is not on the axis, right? And I also changed E hat E, which is not on the axis. There's going to be curve shifting. But it should be entirely obvious if you understand the equation, right? So let's walk through the intuition again. So here's the same as before, right? Must domestic depreciation day. The reason is because fixed expectations. So higher E hat E means that R star, that means foreign deposit rates more attractive, larger interest rate differential must be wiped out to get acceptable equilibrium. And that's only possible if there's domestic depreciation. Okay. All right, so that it can appreciate in the future. The same as the previous slide. Sorry. Let me move this down here. And the carry trader's perspective, I mean the trader's perspective is trivial, right? Borrow domestic, lend foreign, sell domestic for foreign, E must increase. That's it, right? All right, comments, questions on UIP, how to represent UIP graphically when the axes, the x-axis is R and when the y-axis is E. So next week we will expand on the x-axis, right? X-axis is R, and interest rates are controlled by central banks, and we're going to link it to money supply somehow. All right. So empirics. So what I've shown to you is all theoretical. All right. There's no reason for you to believe that it's true, unless you believe the assumptions, right? And those assumptions are quite strong, as I've explained to you what risk neutrality really means. Ignoring risk is kind of absurd. Also, the perfect information story is also quite absurd. But in any case, economists likes to think about long run averages, right? Maybe in some circumstance, those assumptions may be true, but yeah, but in reality, we have to augment the model somehow to reflect empirical data, right? So why does UIP fail? It fails through those two assumptions. So let me write out those assumptions for you, so that it's very familiar to you. So number one, efficient markets, which actually means not only no transaction costs, right? I think that's a given, but also perfect information. So perfect information means that there's no asymmetry in information sets between you and me, between investors and other investors. The market somehow has the ability to aggregate everyone's information sets and be reflected in the price. Number two, risk neutral investors. Risk neutral investors means they only care about expected returns, ignores risk. Some people may argue maybe in aggregate we behave like risk neutral people. I don't think that's true, as you know from CAPM. Maybe I don't know. Maybe at the country level, maybe that's true. I don't know. But anyways, the example I gave you, right, with those gambles is already should only tell you that maybe only certain country pairs make sense, right? If you think about US and UK, I think maybe it's probably true. But we compare US to Brazil, definitely no. Brazil, Argentina, all those South American countries that default on their bonds all the time, you have to have some sort of compensation for those risks, right? And so that's where US UIP fails, right? There's a risk premium in the currency returns beyond mere interest rates. So even if like Argentina says they'll pay 10% interest rates, the likelihood that they actually follow through on that interest payment is, it's not 100%, and you need compensation somehow in order to adjust the UIP equation to make sense, right? We'll talk about that later. All right, another reason why UIP might fail, information is not processed efficiently. So that means that something wrong with E hat E, right? So risk premium, so this first bullet point means that UIP bad model. You need more parameters, maybe. That's number one. Second bullet point, information not processed efficiently. So something wrong with E hat E. Maybe there's somebody with private information the market's systematically not capturing over time. And as a result, people just make bad predictions in the long run. Yes, possible. As I will show you. So here's an example. Expectations may assign a small probability to a large devaluation. This can cause tests to go wrong. So the peso problem. So this is something that occurred in Mexico in the 1970s. So let me explain a little bit. In the 1970s, the peso and US dollars was pegged. Okay, that means there's a fixed exchange rate between these two currencies. So based on UIP, you can already draw some conclusions, right? So let me give you the simplified form, the UIP equation. If exchange rates are pegged, what does this equation reduce to? Let's just say indefinitely. So remember, E hat E is future value of this spot exchange rate, but E is fixed. So what is E hat E minus E over E? E is a constant. What should E hat E minus E over E be? Zero, right? E is fixed. It's a constant. A constant tomorrow minus a constant today is zero, right? Same constant. So R has to be equals to R star, right? But in the 1970s, we observed that R was very much different than R star. This is USD, okay? And this is peso, Mexican. I think it's MXN for peso, which doesn't make any sense, right? So expectations were totally wrong. And there was a subsequent devaluation of the Mexican peso as a result, and obviously DPEG. All right, so that's the information being completely wrong in the markets. And this should never have happened, right? This should never have happened. Those interest rates should be the same, right? And that should also be a little bit informative of what we have in Hong Kong, right? Hong Kong also has a peg, more or less pegged rate with the US dollar within a band. And what your conclusion should be is that when interest rates change in the US, interest rates in Hong Kong should also move in the same way, right? That's what you should draw. I mean, that's the conclusion you should draw from this. Okay, and lastly, exchange rates may contain bubbles or there may be regime shifts. Okay, so it just means that people intentionally devaluing the currency and screwing things up. And then again, I think it's a problem. That just means that there's a problem with EHAE. All right, so hopefully you have a better understanding of using UIP as a tool to forecast exchange rates. It's in textbooks everywhere. Okay, it's tested on the CFA. It's a very easy model to work with. Usually people back test this with for future data. So what they do is they say, oh, EHAE simply is just realized future, right? That's how you back test the model, right? Just to see if it's actually true. And just even if you use this as a simple measurement of EHAE, just assuming you can see the future perfectly, right? This is what it's saying. Assume you see future perfectly and backtest. You will see that UIP just doesn't work out. It's never at parity, and it fluctuates wildly. So this is what I asked you to do in the case study, and which I will post later tomorrow or tonight. Okay. I want you to go ahead and download some data and test CIP and UIP. And you're going to be proxying EHAE using realized future E. Assuming you can see the future perfectly. You're just using future value as an input in your UIP equation. So in contrast to CIP, which you will convince yourself that it's pretty much always satisfied, it has very, very simple assumptions. All you need is the law of one price and no arbitrage, right? That's it. You can restore parity quite easily. And this requires no assumptions about the risk preference of the investor. So that's literally free money, right? That's the only incentive. If there's free money, you're going to go after it. For UIP to be true, you have to have some mechanism to incentivize investors to come in and maximize expected returns, right? And that risk tolerance for expected returns on currency will fluctuate over time for sure. And therefore, all these risk premium that you can think about, they're going to be very volatile, which may explain why UIP is constantly breaking over time. All right, so how efficient are currency markets? So Alan Greenspan was a notorious laissez-faire kind of guy, and he believes that markets were very, very, very efficient. So let me read you what he says. My experience is that exchange rate markets have become so efficient that virtually all relevant information is embedded almost instantaneously in exchange rates, to the point that anticipating movements in major currencies is rarely possible. All right, so that's certainly from a financial economist perspective, that's easy to kind of backtest if that's true, right? In fact, many industry people actually try to construct a carry trade currency index to kind of quantify what you could have made if you decided to implement a carry trade across multiple currencies. And backtest shows that there are notable returns from doing this. So in other words, you need violations of UIP to actually make money through carry trade, right? And this is what Deutsche Bank has demonstrated through their index, their G10 currency future harvest index. So this claim that there's efficiency in the markets and there's no way for UIP to break, that's not true. If it was true, then carry trade would be not profitable on average. But many funds have demonstrated that they've made significant amount of money by implementing carry trade. And in fact, it's still a major investment strategy in Hong Kong, okay, for those hedge funds that operate here. All right, so before we finish today, I will just go over the summary slides, all right, just to review what we learned today. Are there any questions or comments? All right, so a review of the covered interest rate parity first. Very, very simple equation. It has to be true, otherwise there's arbitrage profits. And all it's really saying is that after currency conversion and removal of all FX risk, bank deposit returns between countries have to give you the same value or return, right? And you can easily see that we're rearranging the CIP equation into the following way. So here I'm just multiplying E on both sides, right? And if you read the left-hand side, all it's really saying is that if I deposit E domestically, I will earn E times 1 plus R. On the other hand, if you look on the right-hand side, 1 plus R represents the return you get from 1 unit of the foreign currency, and multiplying F is converting that currency back to domestic currency. So it's, again, literally saying what I just stated earlier. It's saying that deposit returns between countries must be the same after currency conversion. And we remove that FX risk through the forward contract, right? One way to interpret F in relation to E is simply looking at it as a return that kind of eliminates any sort of profit you may get from borrowing low interest rates and lending out at high interest rates, right? That's what 1 plus F minus E over E represents. It's a return to offset any sort of interest rate differentials between countries so that you break even, right? There's no way to make money whatsoever. Interpreting it from this perspective, it's easy to transition to UIP because now we can just think about F as some sort of proxy for future expectation of the spot exchange rate, right? And we need 2 assumptions in order to do that, right? We need risk neutral investors, which means they only care about maximizing mean return. And so whenever there's a violation of UIP, they will just come in and execute carry trade until there's no way to exploit the difference anymore, right? But there is a problem, right? That it's not realistic. Investors definitely have some degree of risk aversion, and therefore you may therefore draw the conclusion that the gap between the left-hand side and right-hand side of the UIP may not always close, right? It could be still violated. You need an offsetting parameter to kind of compensate for the additional risk. For the risk that they have to take on that they're not willing to, right? The second assumption is efficient markets. Efficient markets means that specifically that information is perfectly aggregated by the financial markets, right? There's no such thing as privileged information. There's no such thing as private information. All information is consolidated in the markets and reflected in the prices, and therefore, based on the idea of rational expectations, meaning that our beliefs on average are correct, then we can forecast future spot exchange rate without engaging in F, assuming we're risk neutral, right? We don't care. All we care about is averages. We don't care about if there's, it may or may not. We don't care about risk. So in combination with efficient markets, with risk neutral investors, F can be swapped out with E hat E, right? So you can think of E hat E as, for now, an external variable, right? It's not dependent on any other parameters. It's just something that's concrete and unshakable for now. Okay, it's not, E hat E is not something you can trade on. It's supposed to capture everyone's beliefs about what future E is going to be. All right, so the conclusion you should draw from UIP is that expected returns on foreign currencies are equal to interest rate differentials. So if you see a large differential between a 10% differential between USD and Hong Kong dollar, that means you should expect, so 10% being the US dollar, you should expect US dollars to depreciate 10%, right? That's what it's saying. If R is 10%, and that's the US dollar, is the domestic currency, Hong Kong dollars is 0%, then we should expect the dollar to depreciate by 10%. So I already said this already. E hat E is our anchor of our beliefs about the future, and our beliefs for now assume it's fixed. We learned that based on the equation, E must converge to E in the future, and whenever there is a difference between R and R star, you must have a future offsetting change in the value of the domestic foreign currency or domestic currency that eliminates any sort of interest rate differential benefits. Okay, so we learned that if there is if R is greater than R star, you must have future depreciation, right? Because again, if you're trying to gain from lending out at a higher interest rate, you should expect that the currency that you're depositing in is going to weaken in the future, right? That's kind of the intuition. Whatever interest rate I'm going to try to benefit, there's going to be a subsequent depreciation of that currency. So in this case, if you have R star greater than R, we should expect foreign currency to depreciate or domestic currency to appreciate, right? Appreciation. And then arbitrage or carry trade works through E, right? And I outline those steps every time we shift R or R star or E hat E. Okay. So I believe, okay. Yeah, so I outlined this already, right? Trader's view. So I won't bore you with this again. So I went through this over and over again. So read it through yourself. So the economist's point of view is the equilibrium explanation, right? If you have a larger interest rate differential, then you must have a larger depreciation of the home currency, and that's only possible through changing the spot rate today, right? That's the equilibrium explanation. The trader's perspective is a profit maximization explanation, right? They're trying to make money on average by borrowing low and lending out high, and that's going to push the spot rate in a certain direction. All right, that's it. So if you have questions or comments about today's lecture, I'm sure you probably do. I'm happy to answer them after class. Otherwise, you can turn in your quiz, and see you guys next week.